Well, hello and a very warm welcome to this Scope Ratings webinar on the Ifis NPL 2021-1 ABS transaction, the first Italian securitization backed by direct salary and pension deductions. My name is Keith Mullin, and it's my pleasure to be moderating today's session. I'm very happy to be joined today by Rossella, Ghidoni and Paula Lichtensztein, who both work in Scope's structured finance team and were responsible for rating the transaction, which hopefully you will have seen. We actually published our rating on the 19th of March. In a moment, I'll hand over to Rossella and Paula, who will discuss the transaction's key characteristics and some of the rating drivers. After the short presentation, we'll take some Q&A. So to make this as interactive as possible, I do encourage you to use the questions function on your screen, and we'll do our best to address your questions at the end of the session. So that's it from me. I'm very happy now to hand over the floor to Rossella, who's going to take us through the first slide. So Rossella, welcome to you, and the floor is yours.
Thank you, Keith. Okay. So good afternoon to everyone, and thanks for joining the webinar today with us. Let's kick off. So basically, Ifis NPL 2021 transaction, as Keith already mentioned, is the first Italian public NPL securitization with a relatively new recovery strategy for its unsecured segment, namely a judicial order of assignment, or ODA. The transaction is a static cash securitization of a big portfolio with a gross book value of euro 1.3 billion. The portfolio was originated by several financial entities in Italy, and it was acquired by Ifis NPL Investing SPA in the secondary market. The nature of the portfolio is a mixed portfolio, although it is primarily composed by unsecured loans rather than by secured loans. The portfolio will be serviced by Ifis NPL Servicing SPA, both a special and master servicer. And regarding the liability side, the transaction envisaged the issuance of 4 notes, 2 senior notes, class AX and AY, that we rated A-, and that envisages the payment of interest and principal on a pro rata basis, a mezzanine note, so class B note, that we rated B+, and the junior note, so class J, for a total notional of euro 463 million.
The portfolio is mainly composed of unsecured loans, almost 70% of the total GBV, of which 91% has the wage garnishment order, which we refer as ODA for its Italian denomination. 80% of the GBV are loans granted to individuals. For the analysis, we have split the portfolio into sub-portfolios: the ODA portfolio, made of unsecured loans with a wage garnishment order, and the non-ODA portfolio, composed of standard NPLs, mostly secured. The ODA portfolio accounts for 63% of the total portfolio GBV. Almost 60% of the borrowers in the ODA portfolio are private employees, the rest being pensioners, around 28%, and public employees, 13%. Most of the ODAs have been issued less than 4 years ago, and 3/4 of the borrowers are below 66 years old. The non-ODA portfolio accounts for 37% of the total portfolio GBV, and it is mostly secured. More than half of the senior secured are backed by residential properties, which is positive given their generally higher liquidity compared to commercial or industrial properties. Regarding the geographical distribution, 68% of the properties are in the south of Italy. As regards valuation methods, 51% have been valued with the desktop method and 31% are drive-by valuations.
Talking now about the positive rating drivers for the transaction. As Paula mentioned earlier, Ifis portfolio is composed by these two sub-portfolios, the ODA portfolio and the non-ODA portfolio. The non-ODA portfolio is a typical NPL portfolio, primarily composed by secured loans rather than unsecured loans. As positive rating drivers for this portfolio, we see the fact that 90% of the property's valuations have been performed recently, namely after 2018, and also the composition of the portfolio, because the portfolio presents 61% of the collateral value that is represented by residential assets, and this is above the peer average for the transactions that we have rated so far, that stands at 47%. This is a positive rating driver because residential assets are generally more liquid than the other type of properties, like the industrial, the commercial, the land, etc. Regarding instead the ODA portfolio, we see here three positive rating drivers. The first one that is related to the regularity of the cash flows that are expected from the ODA portfolio. The second one that is related to the fact that the ODAs are valid and non-challengeable. And the third one that is related to the legal costs associated with the ODA. So regarding the first positive rating driver, NPLs that are attached to an ODA generate more regular cash flows than those serviced by other recovery strategies. And this is linked to the nature of the ODA, because with an ODA, the issuer is paid monthly, yes, the seizure of a borrower incomes or of a pension of the pensioner. Even though clearly the cash flows are generally spread across several years in order to fully repay the original borrower's debt. The regularity of this cash flow is also depicted by the chart that you can see here on your right, where you see that there is a material share, so more than half of the ODA portfolio, where the ODAs have always paid on a yearly basis since their issuance. The second positive rating driver, as mentioned earlier, regards the fact that the period for objecting to the ODAs has already elapsed, as represented by the seller. This means that the ODAs for this portfolio that have already been issued are valid, existing, and not challengeable. Furthermore, as represented also by the seller, none of the employers of this portfolio are subject to insolvency proceedings as of closing. And this means that in a short term, the risk of borrowers losing their jobs is limited. The last point is related to the legal cost. As mentioned earlier, since the ODAs for this portfolio have already been issued, this means that the seller has already paid the relevant costs and taxes, and therefore remaining legal costs are expected to be minor. We actually applied a 1% legal cost to the gross cash flows in relation to the ODAs.
Let's now take a look at the negative rating drivers. First one is that there's a high share of under-collateralized loans, as 77% of the secured loans on GVB have an LTV above 100%. This means that for those loans, there's a high probability that proceeds from the sale of the underlying collateral will not be sufficient to cover the full GVB. The non-ODA portfolio has a seasoning of around 15 years, which is higher compared to peer transactions. For secured borrowers, for example, this increases the risk of depreciation of the properties due to properties not being properly maintained over time. The order portfolio is highly exposed to the private sector. The most frequent events resulting in a payment interruption of an order are unemployment and life events, so the loss of a job and the death of the borrower. Private sector employees, which account for almost 60% of the order portfolio, are most exposed to unemployment events compared to borrowers working in the public sector, while pensioners, accounting for 28% of the total portfolio, are not exposed to unemployment events, but they are more exposed to life events. We have taken these risks into consideration when deriving the expected cash flows from the order portfolio. Then there's a material share of borrowers with an order for which there's no information on their employment status, around 20% of the order portfolio's TBV. We have assumed these borrowers have a temporary job. The frequency of unemployment events for temporary workers is higher than for full-time employees. And as we were discussing before, an unemployment event translates into an interruption of the payments under the order. To be clear, the order remains legally valid, but it can be only reinstated when the borrower finds a new job. Finally, there's an interest rate cap that mitigates interest risk on Class AX and AY notes. However, it only kicks in under stressed interest rate scenarios, considering the current interest rate environment. The cap strike ranges from 20 bips in July 2020 up to 3% in July 2037. Well, we have reached the end of the presentation. I pass it to Keith. Thank you very much for your attention, and we now open it up for questions.
Okay, thank you very much for that, Rossella and Paula. And so let me just put the disclaimer up there very quickly while we go to the first question. So please do feel free to ask questions that you may have on the transaction and the transaction structure. So while we wait for that, actually, Paula and Rossella, I had some questions which I thought might be useful if you could take these. And so Paula, I think it's quite clear from the presentation what an order actually is, but for the benefit of those people who may not be completely familiar with this process in Italy, could you actually just kind of briefly explain what an order is?
Yes, of course. Actually, this is part of a legal proceeding. As a result of a court order, up to a fifth of the borrower's monetary compensation, being salary or pension, is sized in order to repay the debt until it is fully repaid. So in practice, the employer or the social security provider deducts from the salary or pension the amount payable to the creditor, so the creditor receives a monthly payment, as we were mentioning before, and this is why this type of strategy is linked to a more regular cash flow compared to other standard NPL portfolios. It is maybe if I can add, the structure is very similar to a CQS, but without the compulsory insurance on unemployment and life events. So these are not really covered as in a CQS transaction.
Okay, and thanks. And Rossella, there are a couple of questions which I perhaps will alert you to read, but while you do that, Rossella, how common is the odor recovery strategy across Italian services? And why haven't you given them credit before?
Thanks, Keith. That's an interesting question. So I would start from why we never gave credit to it before. So the answer to this question is very simple in a way, namely that we never analyzed a transaction, an NPL transaction that was envisaging as of closing already issued order of assignment. And that's why we never gave credit to it before. Now, regarding how common is this recovery strategy across Italian servicers, basically what we see from our monitoring activities, so when we analyze the performance of the Italian NPL securitizations that we have rated so far, is that in reality, Italian servicers do apply this recovery strategy. But the fact is that they apply it in a very limited way. Namely that when we compare the share of collections associated with a wage garnishment recovery strategy versus the share of collections that are associated with judicial recovery strategies or extrajudicial recovery strategies like the DPOs, the not sales, the share of the ODAs is very limited. And this can be explained by the fact that, let's say, to implement this ODA recovery strategy on a larger scale, the servicer must have an adequate IT infrastructure and legal infrastructure to follow not only the issuance per se of the ODA, but also and especially the monitoring phase of the ODA, because as Paula was mentioning before, even after an ODA is being issued, there could be some events that lead to the interruption of payments, like a job loss, a job change, etc. So the monitoring activity is crucial and must be done on an ongoing basis. And the last point is that, in any case, this strategy has clearly some fixed costs, and these costs are typically offset only by large volumes. But since the ODAs are applicable only to individuals, because, you know, they entail with the seizure of a borrower's salary or of a pension, this means that this strategy is applicable only to individuals, while the other typical NPL strategies could apply also to other type of borrowers. So if a servicer is servicing a portfolio that is mostly composed by corporate borrowers, this strategy is in reality not applicable. So that's also a partial driver for it.
Okay, thank you. There are some questions. Rossella and Paula, can I alert you to the questions and perhaps see which ones you want to take?
Yes, I will read one of the questions out loud and answer it. The question is, do I understand correctly that the order loans have not been originated in that form, Cesena del Quinto, but in the assignment has been registered during the recovery process? The answer is yes, this is correct. The underlying loans can be any type of loan, and the order is issued in the context of the recovery process. In essence, it is similar to a repayment plan, but a repayment plan is voluntary, and it is agreed out of court between the creditor and the borrower, whereas the order is, as we were mentioning before, it entails a judicial process with several steps, and it is the result of a court order.
Okay, great. Thank you. And Rossella, there's another question that's come in, which I think I'd like to put to you, which is as follows. What is the average recovery rate of the order part of the portfolio? Is there a different recovery rate between the private sector versus the public/pension?
Okay, thanks, Keith. I think, again, this is a very interesting question. So regarding which is the average recovery rates for the other part of the portfolio, in reality, as shown also in our new issue report, under the class AX and AY analysis, the average recovery rates we assume for the other portfolio stands around a 50% recovery rate, which is clearly, higher than a typical NPL recovery rate that we are used to see for the secured loans that typically bears the higher recovery rates versus the unsecured loans. Now, going to the second question, is there a different recovery rate between the private sector versus public pension? As basically we explained in our new issue report, we first made a vintage analysis, and then we implemented a regression approach. Based on the regression approach, we implemented different rating conditional recovery rate stresses, and these stresses were based also on the nature of the borrower in a way, because among the variables we considered clearly the age, and clearly the typical age of a pensioner versus a private or public sector is different. We considered also clearly the status of the borrower, so whether the borrower was an employed borrower or a pension. And clearly, if a borrower is a pensioner, his expectancy of life is shorter than for, let's say, a private or public debtor. So also the stress on the age of the borrower goes into the direction of differentiating the recovery rates for private versus public and pension. So let's say that in practical terms, yes, we differentiated the recovery rates based on these, on the nature, let's say, of the borrower.
Okay, great. I think, Paula, there's a question I think I can put to you, which is this. Does the order/garnishment concern the original debtor or a third party?
Actually, it can concern both, meaning that the order can be issued either, let's say, related to the guarantor or to the assigned debtor. Actually, let's say the servicer usually investigates before, let's say, starting this type of strategy for a particular borrower. They usually investigate the borrower and the guarantor credit history to assess whether it's legally and economically viable to issue an order, as its issuance entails costs. So it could be on both.
Okay, understood. There's a question here which I can ask perhaps Rossella, which is, how does an ODA portfolio compare to a typical NPL portfolio?
Okay, thank you, Keith. Again, I think this is indeed interesting. So I think we have several dimensions here to analyze the differences. First, as we mentioned already earlier, among the positive rating drivers for the ODA portfolio, the ODA portfolio presents expected more regular cash flows than a standard NPL portfolio due to the nature of the strategy. While by nature, a typical NPL portfolio has completely irregular cash flows. Also, still, let's say on the timing perspective, we can say that the ODA timing relies less than a typical NPL portfolio timing on courts timing. And this is because even though, as Paula mentioned earlier, the ODA strategy is a judicial strategy because the order of assignment is a judicial order and is issued by a competent court. Once the order is issued, basically there is not anymore a reliance on the court because the order has already been issued. While, let's say, for a typical NPL portfolio, there's a stronger reliance on court timing. If we think about, for example, the bankruptcy legal proceedings or the foreclosure legal proceedings, that is ultimately, a function of the geographical area of the court. So that's a significant difference. And the other point that we partially probably already covered before is related to the fact that for a typical NPL portfolio, a servicer potentially has the broadest range of recovery strategies that can be applied based, on the borrower type, so whether it is a corporate or an individual, and on its own securities, whether the loan is secured or not. But for a NODA portfolio, as we mentioned earlier, the, let's say, nature of the portfolio is unique in a way because the strategy applies only to individuals that are employed or retired. And on average, let's say that the exposures are granular. So that's also a significant difference, I would say.
Okay, excellent. Yeah, thank you very much. Paula, can I revert back to you and perhaps ask you to provide some insights into the ODA strategy for this transaction in terms of what Ifis is actually doing, or how it goes about this? Paula, you there? I think we may have lost Paula, who's actually dialing in from afar.
Yeah.
Rossella, are you able to provide any insight onto the Ifis ODA strategy?
Yeah, no problem. So actually, we conducted an operational review with the servicer, and based on that, we assessed, let's say, the servicer capability with reference to the ODA strategy. As we explained already in the new issue report, Ifis typically investigates the borrower's credit history to assess whether it is both legally and economically viable to issue an ODA for a specific borrower. Why this? Because basically the ODA's issuance entails some costs, as we already mentioned before. Then there is a dedicated department in Ifis that follows the relevant legal proceedings until the ODA's issuance by the competent court. As mentioned earlier, the monitoring activity since an ODA is issued is crucial. So the servicer clearly has a dedicated unit that is in charge of monitoring at least 6 months the ODA's performance. But not only, the ODA's performance is measured both in terms of timing and amount. So what is monitored by the servicer is the current ODA status and the installment paid amount. Why this? Because just to give you a very simple example, a monthly ODA payment can change if the salary of a specific borrower, increases or decreases. The timing change. So as Paula mentioned before, we can have some payment interruption in case of a job change, or in case of a job loss, or in case of borrower's death. So the monitoring activity of the servicer is really crucial to avoid these payment interruptions. And in those cases, so when there is a payment interruption, it's key to ensure that the ODA is promptly reissued, because this helps in preventing that other creditors successfully garnish the borrower's salary quicker than, let's say, the servicer can do. So I think that, the monitoring activity is really, really crucial for this type of recovery strategy.
Okay, very good, thanks. And so I have no more questions coming from the audience. So for those of you still logged on, feel free to ask a question in the next 30 seconds. Otherwise, we will close the session. So I can't see any other questions coming in. So Rossella, looks like we've lost Paula, unfortunately, but Rossella, unless you have anything to add, I suggest we close the session.
Yeah, I mean,
yeah.
We can.
Yeah, okay, very good. So look, thank you to those of you who dialed in and stayed till the end. The slide presentation is actually available for download, and we will be following up with delegates after the event. And if you have any further questions, please feel free to get in touch with us, and we'll be delighted to respond to your questions on that basis. So without further ado then, let me close the session. Thank you very much, Rossella. Thank you very much, Paula, for your time and for your insights. We at Scope are doing a lot more of these events, so stay tuned, and we'll make sure that we reach out when our next one comes up hopefully in a couple of weeks' time. So thank you for that, and goodbye from us.
Thank you very much to all of you.
Thank you very much.
Thank you. Bye.